What if I told you that some of the world's wealthiest people legally pay less in taxes than a school teacher, while billions of dollars vanish into thin air hidden in places you've never heard of? Today, we're pulling back the curtain on the secret world of wealth concealment. And by the end of this video, you'll understand exactly how the ultra-rich make their fortunes disappear. But before we dive in, smash that like button and subscribe, because this information is something they don't want you to know. Quick disclaimer, this video is for educational and entertainment purposes only. This is not financial, tax, or legal advice. The strategies discussed are complex and often require professional guidance. Always consult with qualified financial advisors, tax professionals, and attorneys before making any financial decisions. Now, let's get into it. Let's start with the most famous method, offshore tax havens. Picture this: tiny islands scattered across the globe holding trillions of dollars that technically don't exist on paper. Places like the Cayman Islands, British Virgin Islands, and Panama aren't just vacation destinations. They're financial fortresses. These jurisdictions offer what the wealthy crave most: secrecy and near-zero taxation. Here's how it works. A billionaire creates a shell company, a business that exists only on paper, with no employees, no office, no real operations. This company is registered in a tax haven where financial privacy laws are stronger than a bank vault. The wealth gets transferred to this shell company where it sits, growing and multiplying completely untaxed. The Cayman Islands alone holds over $1.4 trillion in deposits. That's more money than the entire GDP of Spain, hidden on an island smaller than most cities. The Panama Papers leak in 2016 exposed over 214,000 offshore entities, revealing how world leaders, celebrities, and billionaires use these structures. But here's the kicker: most of it was completely legal. Now let's talk about something even more sophisticated: dynasty trusts and irrevocable trusts. These are the legal fortresses that protect generational wealth. Imagine creating a legal entity that can last for hundreds of years, passing wealth from generation to generation without ever paying estate taxes. That's exactly what dynasty trusts do. Here's the genius part. When you place assets into an irrevocable trust, you technically no longer own them. The trust owns them. This means they're protected from creditors, lawsuits, and most importantly, taxes. Some states have become domestic tax havens. South Dakota, for example, has abolished the rule against perpetuities, allowing trusts to exist forever. They also have no state income tax on trust earnings and provide ironclad secrecy. Let's use a real example. A billionaire places $500 million into a dynasty trust. That money grows through investments, stocks, real estate, businesses. The trust earns $50 million per year. Under normal circumstances, that would be heavily taxed. But inside the trust, it grows tax-deferred or tax-free, depending on the structure. Over a century, that $500 million could become tens of billions, passing through 4 or 5 generations, and the family might pay minimal or zero estate taxes on the transfer. Now, here's where things get really creative: charitable trusts and the art donation loophole. The ultra-wealthy donate valuable assets, artwork, stocks, real estate, to their own private foundations. They get an immediate tax deduction for the full market value, sometimes worth millions. Let's say you're a billionaire with a $100 million tax bill. You donate a painting valued at $50 million to your private foundation. You just reduced your taxes by potentially $20 million or more, depending on your tax bracket. But here's the brilliant part. The foundation doesn't have to sell that art. It can loan it back to you indefinitely. So you get the tax deduction, but the painting still hangs in your mansion. Private foundations are only required to distribute 5% of their assets annually to charitable causes. The other 95%? It can be invested, growing tax-free. The foundation can even pay salaries to family members who serve as board members. These foundations can also make program-related investments, essentially loans to businesses that might be connected to the family's interests, all while maintaining tax-exempt status. Real estate is perhaps the most powerful wealth-hiding tool that exists, and it's all thanks to something called depreciation. Here's the magic trick. Buy a $10 million building. The IRS lets you depreciate it, claim it's losing value, even while it's actually appreciating. You can write off hundreds of thousands per year against your income. So your building is worth more each year. You're collecting rent, making profit, but on paper, you're showing a loss. Those paper losses offset your other income. This is how billionaires show little to no taxable income. Then there's the 1031 exchange. Sell one property, buy another of equal or greater value, and pay zero capital gains tax. You can do this indefinitely, building an empire while deferring taxes for decades. Real estate investors can trade up properties their entire lives, accumulating hundreds of millions in real estate. And when they die, their heirs get a stepped-up basis, meaning the cost basis resets to current market value. All those accumulated gains, wiped clean. No one ever pays the tax. This is why some of America's wealthiest people are in real estate. It's not just about property value. It's about the tax code being written in their favor. Let's talk about how major corporations make billions disappear through international structures and intellectual property licensing. You've probably heard of the double Irish with a Dutch sandwich. It sounds like a menu item, but it's a tax strategy that saved corporations billions. Here's the simplified version. A U.S. company creates subsidiaries in Ireland and the Netherlands. The U.S. parent company licenses its intellectual property, patents, trademarks, software, to the Irish subsidiary for huge fees. These royalty payments flow from the U.S. to Ireland as business expenses, reducing U.S. taxable income. The Irish company then pays the Dutch company, which forwards it to another Irish company registered in a tax haven like Bermuda. The result? Profits earned in the USA, where the tax rate is 21%, end up taxed at near zero in Bermuda. Billions in profits, pennies in taxes. Transfer pricing is another tool. A company sells products to its own foreign subsidiary at artificially low prices, showing minimal profit in high-tax countries. That subsidiary then sells at market rate, booking the profits in low-tax jurisdictions. All of this is legal, blessed by tax authorities as long as the prices are arm's length, what would be charged to an unrelated party. But the wiggle room is enormous. Here's a mind-bending strategy that's becoming increasingly popular among billionaires. Buy, borrow, die. Step 1. Buy assets that appreciate. Stocks, real estate, businesses. Step 2. Borrow against those assets using them as collateral. Step 3. Die and pass the assets to heirs with a stepped-up basis. Why borrow instead of sell? When you sell stock, you pay capital gains tax, up to 20% federal plus state taxes. But loans aren't taxable income. You get cash without triggering any tax. Billionaires take out massive loans at incredibly low interest rates, often 1 to 3%, secured by their stock portfolios. They live off these loans, never selling, never paying income tax on that money. Meanwhile, their assets continue growing at 7 to 10% per year on average, far exceeding the loan interest. They're essentially printing money while paying minimal taxes. When they die, the assets pass to heirs at current market value. All the accumulated gains are wiped clean for tax purposes. The heirs can sell immediately and pay zero tax or continue the cycle. This is how billionaires can show near-zero income while living lavishly. They're not earning income. They're borrowing against wealth. Life insurance isn't just about death benefits. It's a sophisticated wealth-hiding vehicle. Private placement life insurance allows the wealthy to invest millions into a policy. The investments grow tax-free inside the insurance wrapper. They can access the money through policy loans. Again, loans aren't taxable income, and when they die, the death benefit passes to heirs tax-free. A regular investor pays capital gains tax every time they rebalance their portfolio. Someone using private placement life insurance? Zero taxes on growth, zero taxes on withdrawals via loans, zero estate taxes on the death benefit. Then there's captive insurance, creating your own insurance company. Businesses can deduct up to $2.8 million annually in premiums paid to their captive insurance company. The business gets a tax deduction, the insurance company receives the premiums, and can invest them. The insurance company is often owned by family members through a trust, shifting wealth while reducing taxes. As long as the insurance company covers legitimate risks, and there's wide latitude here, the IRS allows it. It's asset protection, tax reduction, and wealth transfer all in one. The newest frontier in wealth concealment is cryptocurrency and digital assets. Unlike traditional banking, where institutions report large transactions to governments, cryptocurrency operates on decentralized networks. While not completely anonymous, it offers a level of privacy that's difficult to penetrate. Wealthy individuals can hold millions in cryptocurrency across multiple wallets, with addresses that aren't obviously connected to their identity. They can move this wealth across borders instantly without banks or government oversight. Privacy coins like Monero offer even stronger anonymity. NFTs have become a way to transfer and store value in digital art that exists outside traditional financial systems. Tax enforcement is still catching up. While you're technically required to report crypto gains, enforcement is complicated. How do you audit something the government can barely track? Hardware wallets allow storage completely offline. Entire fortunes can exist on a device the size of a USB drive hidden in a safe deposit box or buried location, completely outside the financial system. Behind every massive fortune is a team of specialists working in what's called a family office. Family offices employ tax attorneys, accountants, investment managers, estate planners, and even former IRS agents. Their entire job is to minimize taxes and maximize wealth preservation. These aren't regular financial advisors. They're implementing strategies most people have never heard of, including many we've discussed today, customized to specific situations. The wealthy might pay millions per year for these services, but they save tens or hundreds of millions in taxes. It's an incredible return on investment. Many family offices operate across multiple jurisdictions with entities in various countries all coordinated to create the most tax-efficient structure possible. They also provide asset protection, ensuring wealth is shielded from lawsuits, creditors, and divorces. The goal is making sure wealth stays in the family for generations. So there you have it. The complete playbook for how the wealthy hide their fortunes. From offshore havens to dynasty trusts, from real estate empires to borrowing strategies, from private foundations to family offices. These strategies are legal, sophisticated, and largely unavailable to average people. They're the reason why wealth inequality continues to grow, why the rich get richer while paying proportionally less in taxes. The average person pays taxes on their paycheck before they even see it. The ultra-wealthy structure their affairs so their wealth grows largely untaxed, sometimes for generations. Understanding these systems isn't about envy. It's about awareness. It's about knowing how the game is actually played at the highest levels. If this opened your eyes to how wealth really works, hit that like button and subscribe for more eye-opening content about money, power, and the systems that shape our world. The question isn't whether these strategies should exist. That's a debate for society to have. The question is, now that you know, what will you do with this information?